I want to start with a number, not the oil price, not the inflation rate, a different number, 17%. That single figure represents the abysmal total return of the stock market over the entire stagflationary decade of the 1970s. A deeply ruinous period in financial history where everyday investors were completely trapped in an inescapable economic nightmare of rapidly rising consumer prices simultaneously colliding with steadily collapsing corporate growth. It was a time that thoroughly obliterated the accumulated wealth of absolutely anyone who stubbornly remained positioned for the previous era of easy prosperity and low volatility. Most people look at the terrifying macroeconomic headlines today. They see the escalating geopolitical tension across the globe. They hear the growing whispers of $200 oil, and their immediate visceral reaction is to simply panic. I'm telling you right now, do not panic. Panic is the ultimate enemy of financial survival. Panic clouds your judgment and forces you to make emotional decisions at the exact moment when you need extreme clarity. Instead of giving in to fear, I want you to look strictly at the indisputable arithmetic. I have spent 40 years studying historical market cycles, meticulously analyzing the underlying mechanism of structural market crashes, and I can tell you with absolute unwavering certainty that the vast majority of retail investors and even seasoned professionals are asking the fundamentally wrong question about what is coming next for the global economy. They are obsessively focused on the surface headlines, desperately trying to guess the exact day oil will hit that $200 mark. But the real existential threat to your portfolio is not the endpoint itself, rather, it is the sequence. It is the devastating chain reaction that higher energy costs will unleash upon the broader financial system. When you trace the lineage of market crashes, the most destructive events are never the ones born from a single exogenous shock, but rather from a profound systemic mispricing of foundational inputs. Energy is the ultimate foundational input. It is the master resource that dictates the cost structure of everything else in civilization. If you fail to grasp this, you will be utterly defenseless against what is coming. When you deeply analyze the latest proprietary research from Renaissance Macro and systematically combine it with a 40-year personal track record of successfully navigating these exact types of macroeconomic shifts, a very compelling, undeniable, and frankly terrifying picture begins to emerge. Today, I am going to lay out a precise three-part roadmap of exactly what is about to happen. How the cold arithmetic of global energy shocks will inevitably trigger a devastating multiple compression across equities, and precisely what you must do to adapt, position yourself, and survive this impending storm. First, we must thoroughly understand the physical and geopolitical mechanism of the energy shock itself, moving beyond the noise to see the structural vulnerabilities in global supply. Second, we will look at the inescapable discounted cash flow mathematics that will absolutely crush high multiple technology stocks as the cost of capital permanently shifts higher. Third, we will determine exactly how you should strategically position your portfolio for the harsh new reality of prolonged stagflation. We are going to look closely at the S&P 500. We are going to dissect the trajectory of core PCE. We will examine the VIX, Brent crude, and WTI, and we are going to use the CME FedWatch tool to mathematically prove why the Federal Reserve is currently trapped in an impossible no-win scenario. But first, if this kind of system-level analysis is useful to you, subscribe now. Subscribe now. Let me now be specific about the central geographical and structural bottleneck that guarantees this ruinous sequence will play out, and that is the Strait of Hormuz. When you look at the physical realities of global energy transit, roughly 20% of all global petroleum liquids consumption passes directly through this incredibly narrow, highly vulnerable maritime choke point every single day. If geopolitical escalation results in even a temporary closure or severe restriction of the Strait of Hormuz, the immediate shock to Brent crude and WTI will be unlike anything we have witnessed in modern financial history, instantly propelling prices toward that dreaded $200 threshold. However, as I stated earlier, the raw price of the commodity is merely the catalyst. It is the subsequent mathematical chain reaction that will ultimately destroy massive amounts of equity wealth. Let us do the multiplication and examine the undeniable arithmetic of this scenario. According to rigorous historical modeling, for every 10% sustained increase in the global price of crude oil, we see a corresponding structural drag on gross domestic product and a simultaneous spike in broad inflation metrics. Consider the precise empirical data derived from previous oil spikes. The models constructed by Oxford Economics and the OECD clearly demonstrate that the global economy possesses virtually zero elasticity when energy prices gap up violently over a condensed time frame. Every single time we have witnessed crude oil double rapidly, the resulting shock wave has torn through the S&P 500 earnings yields like a scythe, completely shattering the illusion of corporate resilience. When you apply the widely accepted 0.7 multiplier to a hypothetical 100% doubling of oil prices from current levels, the arithmetic dictates a massive, unavoidable surge in headline inflation that will immediately bleed into core PCE. Do the multiplication. It is not a theory, it is a mathematical certainty that has been repeatedly verified by institutions like Goldman Sachs, the OECD, and Oxford Economics. When you apply that 0.7 multiplier to the current, highly leveraged financial system, the resulting math becomes truly terrifying. It essentially guarantees a localized depression in discretionary consumer spending while simultaneously forcing non-discretionary consumer staples to skyrocket. This 0.7 multiplier means that an extreme oil shock will radically alter the baseline assumptions of every major corporate earnings model on Wall Street. As energy costs aggressively compound throughout the vast global supply chain, profit margins for companies within the S&P 500 will be severely compressed, leading to a catastrophic downward revision in forward earnings estimates. Now, here is the number that truly matters for your survival in this market, and it relates directly to the Federal Reserve. For the past 15 years, investors have been conditioned to believe in the absolute certainty of the Fed put, the implicit guarantee that the central bank will always rush in to aggressively slash interest rates and flood the system with liquidity at the very first sign of severe market distress. That era is definitively over. Because of the stagflationary nature of this impending energy shock, where inflation is artificially driven higher by massive supply constraints rather than robust consumer demand, the Federal Reserve will find itself utterly paralyzed. If you look at the current projections embedded within the CME FedWatch tool, you can see the growing realization among smart money institutions that the central bank cannot simply print its way out of a localized commodity shortage. If the Fed attempts to pivot and cut rates to stimulate the collapsing economy, they will only pour gasoline on the raging inflationary fire, instantly destroying the purchasing power of the US dollar and worsening the crisis. Conversely, if they stubbornly maintain elevated interest rates to combat the core PCE spike caused by $200 oil, they will intentionally engineer a deep, punishing recession that will shatter corporate earnings. Therefore, the most critical realization you must internalize right now is this: the Fed put is suspended. It is gone. It has been entirely neutralized by the macroeconomic realities of stagflation. This leads us directly to the devastating impact of multiple compression and the unforgiving nature of discounted cash flow mathematics. Over the past decade, the stock market, particularly the technology sector, has experienced a massive, unprecedented expansion in valuation multiples, driven entirely by the assumption of perpetually low interest rates and abundant, cheap liquidity. Technology companies, which currently constitute an intensely disproportionate weighting within the S&P 500, are standing directly in the crosshairs of this exact multiple compression dynamic. For years, investors have happily paid 30, 40, or even 50 times forward earnings for these digital behemoths, completely ignoring the reality that such astronomical premiums are mathematically dependent on a zero interest rate paradigm. High multiple technology stocks are uniquely vulnerable to this specific type of macroeconomic shock because their astronomical valuations are heavily dependent on massive earnings projected many years into the distant future. When you run those future earnings through a standard discounted cash flow model, using a significantly higher discount rate, a rate forced upward by sticky, energy-driven inflation, and a paralyzed Federal Reserve, the present value of those distant cash flows absolutely collapses. This is the exact mechanism that will drive the obliteration of the stock market. It will not be a singular, dramatic overnight crash that quickly resolves itself, but rather a grueling, prolonged period of multiple compression where expensive stocks are methodically revalued lower and lower as the market slowly digests the reality of structurally higher capital costs and severely deteriorating profit margins. As the VIX begins to structurally elevate, reflecting the permanent end of the Great Moderation, the market will violently strip away these speculative premiums. The resulting wealth destruction within the tech sector alone will be enough to drag the broader indices into a deep, protracted bear market that could easily last a decade. The VIX, which has remained artificially suppressed for far too long, will inevitably violently reprice to reflect this massive injection of systemic uncertainty, creating a chaotic trading environment that will relentlessly punish passive index investors. We are already seeing the early, unmistakable signs of this rotation beneath the surface of the market indices as smart money quietly abandons overvalued tech darlings and aggressively seeks shelter in hard assets, resilient energy infrastructure, and companies with rock-solid, immediate cash flows that cannot be eroded by an inflationary surge. Renowned market historian Ed Yardeni has recently highlighted similar historical parallels, warning that ignoring these structural shifts is a guaranteed path to severe financial ruin. You can no longer rely on the passive, set-it-and-forget-it investment strategies that generated such effortless wealth during the previous bull market. Those strategies were explicitly designed for an environment of disinflation and limitless central bank support, an environment that has now ceased to exist. The looming threat of $200 oil is merely the match that will ignite this massive underlying tinderbox of overvaluation and extreme systemic fragility. This is not a drill, people. You must fundamentally reframe your entire understanding of risk. You must actively adapt your portfolio to survive a deeply stagflationary trap where traditional 60-40 stock and bond allocations will suffer simultaneous catastrophic drawdowns, exactly as they did during the lost decade of the 1970s. The choice facing you right now is stark, brutal, and entirely binary. You can either choose to stubbornly position your portfolio for the comforting, familiar reality of the past, hoping blindly that the Federal Reserve will somehow miraculously engineer a painless escape from this impossible macroeconomic trap, or you can choose to rigorously position yourself for the harsh mathematical reality of the present. By understanding the intricate mechanism of this global energy shock, acknowledging the suspension of the Fed put, and respecting the brutal laws of discounted cash flow mathematics, you can actively protect your accumulated wealth from the impending multiple compression. Do not be caught off guard when the massive geopolitical dominoes finally begin to fall, and the true devastating consequences of this supply bottleneck are felt across every single sector of the global economy. The data is absolutely clear, the historical precedents are overwhelmingly compelling, and the underlying arithmetic simply cannot be debated or ignored by anyone who is paying attention to the broader macroeconomic landscape. The era of easy money is dead. The structural constraints on global energy are tightening by the day, and the resulting chain reaction of inflation and economic stagnation is already locked in. Prepare yourself, protect your assets, and understand that the sequence is in motion.